So in tax planning, we'll be looking at 3 areas. So there'll be individual tax planning, then we'll be doing tax planning by corporates, called corporate tax planning. And finally, look at cross-cutting issues. So cross-cutting means this will be matters of tax planning that will both involve individuals and corporates. So let's start with individual tax planning. So the first part of tax planning will be individual tax planning. In other words, do we have legitimate ways in which an individual can reduce their tax liability? The answer is yes. And there are quite a number we'll be looking at as an employed individual or even as a person in business. There are ways in which a person can deliberately reduce the amount of tax. So we'll list them. So the first one is called contributions to a register. Contributions to a registered pension scheme. Contributions to a registered pension scheme. Contributions to a registered pension scheme. So we say contributions to a registered pension scheme. Contributions to a registered pension scheme are tax allowable deductions. Contributions to registered pension scheme are tax allowable deductions. Subject to a maximum of 20,000 shillings per month. Subject to a maximum of 20,000 shillings per month. Subject to a maximum of 20,000 shillings per month, or in brackets, 240,000 shillings per annum, or in brackets, 240,000 shillings per annum. 240,000 shillings per annum. So that essentially means if, say, you have some basic salary of some amount, say the basic salary is 35,000 a month, you essentially say there's contribution to pension. So we usually compare contribution to pension. Say actual contribution, how much are you saving? So actual amount. So the actual amount could be, say, 8,000 shillings per month. You compare with the set limit of the maximum allowable per year or per month, 20,000 per month or 240,000 per year is the set limit. Out of this, you deduct the lowest. So allowable deduction means you reduce the taxable income by that much. So that means you'll be taxed on 27,000 instead of 35. That will now be the taxable income, and that is the opportunity there. For saving, it will reduce the amount of tax exposure by the amount you are contributing. So of course, the amount you're contributing is based on what an individual can afford. So there's no statutory minimum, but then there's a limit, there's a statutory maximum as to what can be allowed as a deduction, and the maximum is 20,000. So it means for those with ability to contribute more to their pension, like if a person can contribute 25,000, the maximum they can get is 20 as deductible. Next point, still on the same, on retirement. On retirement, on retirement, the pension income received in lump sum on retirement. The pension income received in lump sum on retirement, the pension income received in lump sum is exempted from taxation. The pension income received in lump sum is exempted from taxation up to 600,000 shillings. Up to 600,000 shillings. Up to 600,000 shillings. Then you continue. In case of periodic pension income, 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 the first 25,000 shillings, the first 25,000 shillings received per month, the first 25,000 shillings per month, or in brackets 300,000 shillings, or in brackets 300,000 shillings per annum is exempted from taxation. Is exempted from taxation. So we are saying there are two tax opportunities here on the same contribution. So this is a benefit enjoyed as a contributor. We've said it will give you a tax allowable deduction. It will reduce your taxable income. There's a second opportunity to benefit, and that's as a pension, as a retiree. So as a retiree, there are two modes a person can choose to be paid. If it's a provident fund, then it's a one-off payment. We call it lump sum. And so there's a difference between a provident and a pension scheme. Both of them are retirement schemes, but a provident fund has only has a provision to pay only lump sum. But a pension scheme has two provisions. It can pay in lump sum or it can pay in periodic amounts, whichever, say, the pensioner chooses. Now, opportunities are given for both. If it's in lump sum, because pension is still subject to taxation, then the first 600,000 contributed to a scheme which is registered or recognized by the commissioner will be exempted from tax. It means the amount of tax will only be chargeable on whatever is above 600, not whatever is less. For a person who has worked for less than 10 years, then will take 60,000 for each year worked. So if, say, a person has worked for only 7 years, then will not use 600,000. We'll use 60,000 times 7. So that will be the first 420 in lump sum. Then there are those that can be paid in terms of every month for pension, periodic pension. Then the first 25,000 received monthly basis will be exempted from tax, or 300,000 per annum. That is the first opportunity, contribution to a registered pension scheme. There's a second one. Number two is called contributions to a registered, contribution to a registered, contribution to a registered home ownership, contributions to a registered home ownership savings plan. So RHOSP, contributions to a registered home ownership savings plan, or RHOSP. Contributions to a registered home ownership savings plan, or RHOSP. So any citizen who can wish to acquire property, a house, can take advantage of this to make contributions to a registered home ownership savings plan, probably a scheme that is managed by financial institutions like HFCK. HFCK is an institution known for home mortgages, for home ownership savings plan. So this essentially is a scheme where you enter into an arrangement with a financial institution and you make savings on a monthly basis. And these savings are very specific towards owning a home. Now, the window should be 10 years. Now, these contributions are meant to earn interest. So this institution is supposed to include some interest on this amount. So the contributions together with the interest will be paid to the contributor after a period of 10 years so that it can facilitate them to maybe buy land and build or buy a home, depending on how much they're saving. But in the meantime, what is the incentive or what is the opportunity for savings? Now, armed with the documentation for this kind of scheme, your employer will be able to deduct from your employment income a further 8,000 shillings per month or 96,000 shillings per annum. So further reducing the amount of tax exposure. So contribution to registered home ownership savings plan. So we say contribution to RHSOP. Sorry, contribution to RHOSP. Contributions to RHOSP. Contribution to RHOSP is allowable deduction. Contribution to RHOSP is allowable deduction. Contribution to RHOSP is allowable deduction up to a maximum of 8,000 shillings per month. Up to a maximum of 8,000 shillings per month. Up to a maximum of 8,000 shillings per month, or in brackets, 96,000 shillings per annum. In brackets, 96,000 shillings per annum. 96,000 shillings per annum. Same point you say, in addition, the interest on deposits. In addition, the interest on deposits. In addition, the interest on deposits of up to 3 million shillings. In addition, the interest on deposits of up to 3 million shillings. In addition, the interest on deposits of up to 3 million shillings into an RHOSP, shall be exempted from tax. Shall be exempted from tax. And then number 3 is mortgage interest. Mortgage interest. So a few Kenyans may afford this kind of arrangement called mortgage. It's not very easy, but depending on how you agree with the bank. So this is where the bank buys one-off, makes a one-off payment, and you're allowed to acquire property. As the bank will retain the title, and you continue making payments for 15 years, maybe 20. But if you have the ability to pay even faster, it's even better. If you can be giving the bank some lump sum, and maybe you finish. So it's an alternative to this one. But this one would be more affordable to most people, considering the level of income. That could be a bit strenuous when it comes to interest, because take a mortgage of some amount of, say, between 4 million and 5 million, you're likely to pay not less than 90,000 every month. Interest alone. I don't know how many Kenyans can afford that. 90,000 per month. And then there are always the risks that you must be consistent. You cannot afford to fail. Not in 1 month, not in 2 months. If you fail, the banks will not hesitate. They'll not even understand. They'll take away the property and you lose everything you've ever paid. You can take the experience of COVID, for example. Something like that can happen. Nobody knows about tomorrow. Maybe you're in the hotel industry and you suddenly lose your job. It will be double tragedy. You not only lose your job, you lose your property. Because banks will not understand. So this one is could be a bit tricky. But on the good side of it, it doesn't entirely depend on what you earn from salary. So people can be very creative. I know of many young people who are very, very creative, and they're doing many things by the side. So the banks are just interested on the activities in your account. So it's not necessarily what determined on the payslip. So if you have proof of payment, whether you can pay from farming, or whether you can pay from business, or whatever businesses you're doing, and you can say persuade the bank, they can look at your account and they can see fairly good activity, you can still access a mortgage. It doesn't have to be through a salary. In my opinion, it's more difficult for a person that is entirely depending on the payslip. It will be better if you're depending on a payslip. You had better be earning 150,000 plus, and 150,000 plus. Realistically speaking, that's not many Kenyans earning that. But those who would be earning that kind of amount can easily get this facility. 150,000 or above, they can survive it. Or hardworking Kenyans who are doing other things, not necessarily salary, can still take advantage of mortgage. So mortgage interest, you say, the interest on a personal mortgage, the interest on a personal mortgage, the interest on a personal mortgage that is used to acquire, the interest on a personal mortgage that is used to acquire an owner-occupied property, the interest on a personal mortgage that is used to acquire an owner-occupied property is allowable deduction from income, is allowable deduction from income, is allowable deduction from income up to a maximum of 25,000 shillings, up to a maximum of 25,000 shillings per month, up to a maximum of 25,000 shillings per month, or in brackets, 300,000 shillings per annum. In brackets, 300,000 shillings per annum. In brackets, 300,000 shillings per annum. Number 4, individual investment in various assets. Individual investments in various assets. Individual investment in various assets so as to avoid taxes on capital gains. Individual investments in various assets so as to avoid taxes on capital gains. So the main investment here is to invest through collective investment schemes. Collective investment schemes. And take advantage of the provision in the Income Tax Act that has made income of collective investment schemes totally exempt from tax. A collective investment scheme could be a unit trust by Old Mutual. There are many. If you look at any newspaper, you find so many kind of trusts listed. This is one of the oldest, but there are many others. There are many other classes of unit trusts by different companies. Then you have real estate investment trusts. Real estate investment trust is also included in this category. So these are called REITs. Now, how do this work? They work by recognizing that individuals may not have sufficient leverage or sufficient amounts on their own to invest in certain assets. Like you might have a desire to invest maybe in real estate. Real estate means you want to invest in hostels as to raise money or as an income generating, or you want to invest in offices within property. But then what you might not be having might not be flexible enough, and you might feel also the market is fairly risky. So these collective investment schemes we are talking about are fairly secure because they are all regulated by the Capital Markets Authority. So they are regulated, so the small saver is protected by CMA, by Capital Markets Authority. So the regulation requires even the Capital Markets Authority to approve even the managers in these schemes. Now, how does it work? So individual will buy units based on what they can afford. So the unit here is equivalent to a share, even in real estate. So once the funds have been pooled together, then the funds become more flexible. So there's an investment team that puts these funds to investment in whatever, like for real estate investment trusts, they invest in property. They invest in offices, in warehouses, in shopping malls. Like there's one called Stanley. Stanley is a real estate investment trust whose shares are even listed at the Nairobi Stock Exchange. So this kind of investment in vehicles will give the small holder protection because they are regulated by the Capital Markets Authority. But for tax purposes, collective investment schemes are exempted from tax except for withholding taxes. So should any of this be invested in government treasury bonds or even the shares of companies, then the only tax is withholding taxes at the source. Where once this income is received by the collective investment schemes, it's going to be shared to the units at no other tax. And in any case, the CME regulations require they must distribute 80% of what they get. They must distribute 80% to the holders. So it's an area individual shareholders might want to look at instead of being conned. Okay, I'm not saying everybody is conned, but especially in Nairobi and in some places, people have lost money while trying to invest in land. You know, I have a colleague of mine once bought 2 pieces of land somewhere in Komaro, I think around there, Kayole, only to appear there to try to fence. He found Mungiki there with pangas. They told him, next time we see you here, your neck will be left here. So if you're told that, you'll never appear again. The next time we see you here, your head will be left here. So he lost about 600,000 investment. He never went back. So sometimes you are successful, sometimes you get problems, you fall into headwinds like that, but this, the CMA will bear responsibility. At least there are certain requirements, like one of the requirements, there's a list of requirements. To be an investment manager, they need certain minimum conditions, and this unit trust must also be having a trustee. A trustee is a bank. They must get connected to a bank who will appear as a trustee for them. So there are very elaborate conditions that is required for them to operate under the Capital Markets Authority, which makes them, okay, nothing is 100% safe, but fairly safe investment compared to going out there to meet brokers. Okay, meeting brokers, sometimes you succeed, sometimes you fail, but if it's your hard-earned money, it might be very sad, you know. So conducting, we say individual investment in various assets so as to avoid taxes on capital gains. You say this exemption can be enjoyed. This exemption can be enjoyed. This exemption can be enjoyed. This exemption can be enjoyed by investment through unit trusts. This exemption can be enjoyed by investment through unit trusts, by investment through unit trusts, or other collective investment schemes, or other collective investment schemes, or other collective investment schemes, such as real estate, or other collective investment schemes, such as real estate, investment trusts, such as real estate investment trusts, or in brackets REITs, or mutual funds, then you say such investment vehicles are only subject to withholding tax. Such investment vehicles are only subject to withholding tax. Such investment vehicles are only subject to withholding tax on dividends and interest income, on dividends and interest income received, on dividends and interest income received, any subsequent distributions of profits to the members, any subsequent distribution of profits to the members are exempted from taxation. Number 5, conducting business using a corporate entity. Conducting business using a corporate entity. To enable. Conducting business through a corporate entity to enable comprehensive deduction. Of business expenses. I don't know whether you've noticed, but you must have noticed this when we were looking at partnership. So in a partnership, because we said a partnership is not a legal entity, there are a lot of expenses we disallow. And that is what happens in reality. It's difficult to separate or to segregate between personal and business expenses. But when you go ahead and register a corporate, so that you conduct your business through a corporate, whether it's a service business or even you're delivering goods, then there's a clear segregation between you and the business. Now, that way, you'll find that even expenses that would have been disallowed, were it an individual or a partnership, will now be allowed. For example, certainly salaries, which when you pay to partners are disallowed. They are called partners' salaries, they're disallowed. But in a company, you call it the same thing, directors' fees, and it's allowed. Or even traveling expenses. If it's for business, for a company, it will be allowed. For a partnership, it will not. They'll say it is personal, and so on. So segregation gives a very, very big advantage, such that you might find a company gets to pay taxes only on what is left. So they are allowed to charge certain expenses. Take examples of our local entrepreneurs like Churchill Life. He's registered a company called Laugh Industries. So under that cover of Laugh Industries, he's able to charge expenses, including their traveling costs. I say they have a show somewhere in Thika, or they have a show in Nakuru, and he pays transport costs for his comedians to go there, including costs of maybe food, and entertainment, and even where they sleep. They'll charge, but imagine it was an individual partnership. All those will be considered as personal expenses. So there is certainly an advantage in operating as a corporate, because you'll be allowed to prepare a statement of income, and most of the expenses, except in the extreme cases, would be allowed. So you'll only pay tax on whatever is left of the business expenses. So, but if the same business is being conducted as an individual, a lot of those expenses will be disallowable as personal. So conducting business, you see, while expenses that are legitimately incurred, in the production of income, while expenses that are legitimately incurred in the production of income, while expenses that are legitimately incurred in the production of income are tax allowable, conducting business using a corporate entity, shall enable a clearer segregation. Shall enable a clearer segregation of business. Shall enable a clearer segregation of business and personal expenses. Shall enable a clearer segregation of business. Shall enable a clearer segregation of business and personal expenses. Thus enhancing the deduction. Of certain expenses. When you say individuals engaged in various professions, individuals engaged in various professions, including entertainment, can set up companies. Can set up companies. To which they can direct their income. This will enable the taxable income to be reduced. By charging those expenses, which they would fail to deduct, if they had conducted their businesses, if they would have conducted their businesses as individuals, Number 6, establishment of charitable trusts. Or foundations. Again, this is an opportunity. If you look around, you'll find a lot of politicians have charitable trusts, some have foundations. I'm sure they know about the tax advantage. So if you have property, or you have an asset, or you have shares, which you wish to set aside, you could allocate the shares to a trust, or to a foundation, or to a charitable organization. But the management of a trust does not have to be an outsider, does not even have to be a lawyer. You can employ your own children to manage the trust, or your spouse can manage the trust. All you need to do is to sign an agreement. It's called a trust deed. So the agreement gives the particulars of the assets you have, allocated, and how you wish the assets to be invested, and then how you wish the income to be distributed. For what purpose? For what charitable purposes? The charitable trust could have been, the beneficiaries could be your family, right? Or the beneficiaries could be any other cause. Now, what's the tax advantage here? Once the trust has been established, it becomes a separate entity from you. So nobody will ever ask you about any tax matters. The persons with the responsibility will become the trustees who are handling the management of the trust proceeds and the trust assets on your behalf. So that property or those shares or any income generated by that trust will no longer be your responsibility in terms of tax. It will no longer be taxed on you. And if the tax is specifically registered as a charitable trust, for example, we'll look at the conditions for a charitable trust, then again it will be totally exempted from tax. So establishment of a charitable trust or foundation. So we say the Income Tax Act provides that the income of a trust, the income of a charitable trust, the income of a charitable trust or foundation, the income of a charitable trust or foundation, the income of a charitable trust or foundation is totally exempted from taxation. It's totally exempted from taxation. It's totally exempted from taxation under the following conditions. Is totally exempted from taxation under the following conditions. A, it is public in character. It is public in character. It is public in character. B, it is established solely. A is, it is public in character. B, it is established solely for the purpose. It is established solely for the purpose of relief of poverty. It is established solely for the purpose of relief of poverty or distress. Relief of poverty or distress to the public, or C, it is for the advancement of religion. It is for the advancement of religion. It is for advancement of religion. It is for advancement of religion or education. It is for the advancement of religion or education. And lastly, D, the income of the trust, is expended in Kenya. The income of the trust is expended in Kenya for the benefit of citizens. So you can register your trust under any of those, like Strathmore, a very prestigious organization, if you may ask, a top institution as far as academics is concerned, but it's registered under an educational trust. So they argue that they are not established to make profits. They argue, you might say what they're charging is high, but they're telling you that cannot even pay the cost. of what they provide. So they are not a profit-making organization. Okay, so despite the fact that they even tell you, if you go for their course, they'll tell you, we would urge you to get sponsorship, because you might not personally manage to go through with this. You know, if you compare to what the other institutions charge, then comparatively it's very difficult to raise. If you go to the MBA class, then it is who is who in some of the management boards in the country, because those ones will be sponsored by their organizations, because you want to be associated with Stratton. So you go there. But they will still tell you, despite all that, we are not a profit-making organization. We are here for, we're just here to you know, for educational purposes. We have a passion to enhance education in this country, not to earn income. Probably it's true. Probably it's true. How? Okay. I'll only express an opinion. I'll only express an opinion because I've had the privilege of teaching some of their students when they were going through their programs. I've had more than one student from there. Like, I had one student for some time. I was taking some units. She was taking an MBA there. She's done now. If you consider what they offered, for example, for attachment, she went to New York. Even though she was, those are parts she paid. I think she had to book her own tickets, but she was in New York for 2 weeks. I don't know how many institutions here have such arrangements. And on several occasions, as part of their coverage of their units, they are to invite some people from society in very high positions. For example, on some occasions, they would invite the Chief Justice to have a talk with them, and the Chief Justice doesn't come for free. They're paid. Or the central bank governor, they just cannot allocate their time. Now, those of them in like hospitality courses, I know of students that have gone to, I think, Switzerland for attachment, and they've been there like for a month. Those who are doing hospitality. I don't know of any hospitality training around that takes students to Switzerland. You know? So I don't know. Maybe considering what they do and how they are really making effort to distinguish what they offer from what other people offer. Like for that example, most of their MPA program is not taught in class. They meet in hotels outside this country. Who has that unique experience? They meet with laptops somewhere in Nakuru. And at that time, you have an opportunity to network because your classmate happens to be CEO of Equity Bank or Chief Operating Officer of Equity Bank is your classmate. So I don't think they would want to admit every Tom, Dick, and Harry in a class like that, because you'd even really bother your classmates. Because so maybe if you sum up everything with all things said and done, probably you might think maybe they have a point. They are visiting lecturers from some of the top universities. They only invite people from Ivy Leagues. You know Ivy Leagues? Some of the top universities in the US, like California University, Massachusetts, MIT, such, you know, to be visiting lecturers, come and do some of the units. So these professors are not based here. They only come here purposely to deliver on certain units and go back. So that tells you the guys are really determined to offer quality. Not even Nairobi University does that. What?
You also a lecturer as well.
Okay, my role is different. I don't teach at Strathmore, but like this student I'm telling you, she was referred to me by someone. I did not know her initially. She works for USAID, yeah? But by the time she was being referred to me, she had already 3 supplementaries. The program she's doing was economics related. So I was going to help her with those units to survive. Otherwise, she was about to be kicked out. And well, things turned around from the time she met me. That's why she never stopped until she graduated. Things turned, she never got another suit again. And part of her problem was this. Her first degree she had done was in law. So obviously she had no background for an economics related course. She didn't have such a background. So that explained why. It doesn't mean she didn't have the capability. It only means she lacked the background totally. And everything was new because if you start with units like global economics and international economics, and you don't even have the basics of what is demand and what is supply, then you have a problem. So by the time she was being referred, she already had 3 supplementaries. So we worked on it, and she graduated in flying colors. So she'll forever be grateful. And big doors open. Some of these things open big doors. For example, USAID recognized her qualifications even before she graduated. She was promoted. You know, because of that, she was very grateful. Yes.
I don't know if it's really, but the staffs of these charitable organizations, they pay normal PAYE taxes. They don't have any.
It's normal employment. So you're employed. Yeah. Yes, we must pay taxes. Even if you're employed in a church, you'll pay taxes. It's not you who is exempted, it's the church. Even a pastor ought to pay taxes, but if you follow through, you'll find they sleep around, you know, but the right thing is a pastor doesn't work for free. So what he's doing under payee regulations is an employee, though they don't want to be called that. They give you all sorts of justifications that their role is higher than. But for simple definitions of PAYE, they're employees because for the simple reason they are not working for free. Are they? No. They are not working for free. So what they are giving is an employment service. So they have a contract with the church or with the congregation. For that, they get something in return. So they're employees just like anybody who is being paid, unless they will tell you they are doing that for free. So in short, they should have a pay slip, just like anybody else, and everything they earn should be included, including the allowances they're given every week. But I know they don't do that. You know, all that should be put in a package so that they pay tax. What is exempted as specific things, like any donations they get, or anything you pay as tithes and offering. That doesn't come from any investment. But some churches have diversified business. They are operating a school, others are operating a hospital. That's a business. Like St. Mary's, where the Catholic Church was almost pulling each other's eyes out because of St. Mary's. You know the story behind St. Mary's? The one in No. This one at Langata. You know, finally they threw out the guy who initiated. Yeah. The priest who initiated. They caused a lot of problems for him. He was even thrown out of his congregation. Simply because he dared to say, look, this was my baby. It is me who started this. Please. They could hear none of it. So they threw him out and he lost it. Now it's being run by some nuns. Yeah. So that's how far we've gone as a people, you know, and property. So that's charitable organizations. So under those conditions, they'll be exempted. Number 7, lower rate of taxation. Lower rate of taxation for partial motor vehicle benefits. Lower rates of taxation for partial motor vehicle benefits. Lower rate of taxation for partial motor vehicle benefit. Lower rate of taxation for partial motor vehicle benefit. So I'm sure you know that if your company gives you a car for personal usage, we normally tax the personal usage, not the business usage. So if you get a car but it's purely for business, I've seen like in some companies you use the car, but you leave it in the pool, you don't take it home, then there's nothing to tax. There's zero tax there. So we're saying partial benefit could be in such kind of arrangement. For example, where you limit the usage of the car, most of it, to a greater extent for the business rather than for personal, because what attracts taxation is the personal usage. So if the car is given to you purely to transport you from home to work, you are with it throughout the weekend, then you'll be taxed as a benefit. How the benefit is calculated, you look at the engine capacity. Normally those rates are given. Is it 2000 cc? Come on, in 2000 cc, the charge is 7,200 per month. It has stayed like that for many years, or 86,400 per annum, or you get 2% per month of the initial cost of the car, and that is added to your salary as a benefit. But alternatively, if the car can be justified, that you have the car purely for business, maybe you come pick the car and you work with it, you're a salesman, and that's all, then you leave the car in the company, there'll be zero tax. So the benefit only comes because of personal usage. So you say an employee enjoying the use of a company car, an employee enjoying the use of a company car, an employee enjoying the use of a company car is taxable on the benefit. An employee enjoying the use of a company car is taxable on the benefit at the higher of the following. At the higher of the following. At the higher of the following. A, the amount quantified. The amount quantified. The amount quantified based on the CC rating. The amount quantified based on the CC rating of the car. The amount quantified based on the CC rating of the car, or B, 2% per month of the initial cost of the car. 2% per month of the initial cost of the car. 2% per month of the initial cost of the car. Then you say, however, the determination of the motor vehicle benefits, will take into account the purpose. However, the determination of the motor vehicle benefit will take into account the purpose and extent. The purpose and extent of usage. The purpose and extent of usage of the motor vehicle. The purpose and extent of usage of the motor vehicle. Then you say this serves to reduce the value. This serves to reduce the value of the taxable benefit. This serves to reduce the value of the taxable benefit. This serves to reduce the value of the taxable benefit where the employee where the employee had used the vehicle, to a large extent, where the employee had used the vehicle to a large extent for official purposes. For official purposes. For official purposes. Then we have number 8, remuneration by way of shares. Remuneration by way of shares. Remuneration by way of shares. So there are a number of companies around that wish to motivate employees, and also they want the employees to think of the company from the shareholders' perspective, not from an employee's perspective. Because if you think in terms of an employee, you'll think of your interests, not the interest of the company. One way is to offer shares. KCB does that. Safaricom does that to a very large extent, though mostly to top management. They give them shares. They actually buy shares from the market at market price and give them to employees. Equity also has such a program, but the one for Equity is very controversial because I've come across a number of employees who say Equity Bank will ensure you don't benefit from those shares. They'll either kick you out because part of the condition is that you survive for a number of years. So they'll make sure they kick you out before you survive the number of years. So you lose. So a number of people I've seen really cry bitter tears. They can't access the shares that were supposedly given to them. In quotes, they can't access. But the one for Safaricom works. They provide shares very, very frequently, and they give quite a bit of shares to, especially to those in top management. Now, how does this work? Usually the shares are offered at a lower value. At a lower value than the market price. So the gain is the difference between the market price and the value of the shares. Then the opportunity here is the timing. The timing is this. You might be given the option to take up the offer, but if it's conditional like equity, it might be a while before you can take up that option. The shares are already vested, yes, but you're told it's conditional. Maybe you can take up the offer after 3 years. After 3 years, there's a possibility that the market price of the shares could have increased in value because the shares are traded at the stock exchange, but the tax basis will be based on the date when the shares were vested, 3 years ago, on the date when the shares were vested. So if you are taxed, the tax basis will be, they'll get the difference between the market price at the time of vesting, the market price, minus the low price you pay, the price at which, or the offer price, minus the offer price, which is usually low, times the number of shares. You multiply by the number of shares. These details will be the date of vesting. And the date of vesting is different from the date when you can exercise the option. The option is exercised later, after you've met the requirements. It will be 3 years after that. So the capital gains will not be taxed. They escape tax. So remuneration by way of shares, you say employee share ownership schemes. Employee share ownership schemes allow for the granting of share options. Employee share ownership schemes allow for the granting of share options to employees. Allow for the granting of share options to employees. Then you say such remuneration is taxable Such remuneration is taxable at the earliest of the dates. Such remuneration is taxable at the earliest of the dates. Such remuneration is taxable at the earliest of the dates when the options vests. When the options vests. When the options vest on the employee. When the options vest on the employee and the date of exercise of the options and the date of exercise of the options and the date of exercise of the options and the date of exercise of the options, or at the end of the period, or at the end of the period of restriction, or at the end of the period of restriction, or at the end of the period of restriction, under a restricted stock scheme, or at the end of the period of restriction, at the end of the period of restriction, under a restricted stock scheme. Then you say this creates an opportunity for tax exemption. This creates an opportunity for tax exemption. This creates an opportunity for tax exemption on any increase in the value of shares. On any increase in the value of shares. On any increase in the value of shares from the date, on any increase in the value of shares, from the date the shares vests. From the date the shares vest, from the date the shares vest and are taxable, from the date the shares vest and are taxable, to the date of the actual exercise. To the date of the actual exercise, to the date of the actual exercise of the option. The date of the actual exercise of the option. Then the last one, number 9, insurance relief. Insurance relief. Insurance relief. Insurance relief, then you say, individuals are entitled to an insurance relief. Individuals are entitled to insurance relief. Individuals are entitled to insurance relief of a maximum of 15% of premiums paid. Of a maximum of 15% of premiums paid. Of a maximum of 15% of premiums paid on life. Of a maximum of premiums paid on life, education, or health. On life, education, or health policies. On life, education, or health policies. On life, education, or health policies. With a maturity, sorry, don't write with the maturity, for self, spouse, or child. For self, spouse, or child. For self, spouse, or child. The combined relief shall be subject to a maximum. The combined relief shall be subject to a maximum. The combined relief shall be subject to a maximum. The combined relief shall be subject to a maximum of 60,000 shillings per annum. Shall be subject to a maximum of 60,000 shillings per annum. So that's it. So those are some areas of, I say, tax planning for individuals. I want us to look at a question or so. So there are two ways the examiner can bring a question in this area. One way would be where the examiner asks you to suggest a scheme of tax planning. You'll be given details of a family or an individual, employment detail. This is what they earn, this is what you are doing. Then the examiner will ask you, can you prepare a scheme of tax planning for this family? In other words, what opportunities do you think they have to reduce their tax liability? That's one way. Another way, which I've not seen them examining for a while, is where you're given options for employment and you're given a list of benefits an employee is likely to get. Then the examiner wants you to advise this person. What should they take in terms of employment opportunities? Should they take option A or option B? Now that may require an analysis of whatever has been provided, whether salaries or benefits, and then you give the allowable deductions, then you'll be able to advise. So we'll look at two questions, one on each of the areas. So the first question I want us to look at is where you suggest a scheme of tax planning, or you suggest to the taxpayer how they can reduce their taxes. Then we'll look at another way where maybe you also provide advice on what options they should take in terms of employment based on the analysis you provide. So there are those two approaches which we need to look at. So the one for a scheme, the most recent question must be somewhere in which year? A scheme of tax planning must be somewhere in 2017. Yes, May 2017, question 3C. No, it's B, not C. May 2017, question 3B. Come up with a scheme of tax planning. Should be May 2017. May 2017 should be question 3B. So you found it, huh? So look at May 2017. It's November, not May. November 2017, question 3B, November. It's called undo mode. I think the same question is repeated somewhere in 2018, but I can't remember where. So tutafanya tu ya November, because the same question is repeated. Ni majina tu wamebadilisha. Kwa sasa sikumbuki ni question gani ile latest nilikuwa nataka tufanye latest should be after hiyo. Sikumbuki ni mwaka gani hiyo. So nitaitafuta baadaye kwenye. Oh, I found it. It's November 2020. Wacha tufanye November 2020. Let me find the latest. November 2020, question 5B. Anaitwa Albert Kimeli. November 2020. November 2020, question 5B. 5B, so we read that. November 2020, question 5B says, hata tunaweza fanya part E, because part E is what we were discussing today, transfer pricing. So inasema globalization, diversification, and expansion have forced companies to form groups where a large number of transactions are between related parties. In light of the above statement, 1, explain the terms related party transactions and transfer pricing, and 2, evaluate 2 benefits that may accrue to an entity that applies transfer pricing in transactions between related parties. Then B, Albert Kimeli is an employee of Worker Limited. He has provided the following information relating to his income. He earns basic salary of 60,000 per month. He's paid house rent, allowance of 30,000 per month. His wife, Lavena Kimeli, is also employed at a salary of 54,000 per month with Tops Limited, where Kimeli holds 20% of the shares. They both live in a company house, which is owned by the wife. The house was constructed through borrowed funds at an interest rate of 15% per annum. 5, the employer paid school fees for the children of Albert Kimeli. 6, he was a member of an unregistered pension scheme where the employer made contributions towards the scheme on his behalf. 7, the wife runs a farming business where she earns 400,000 from sale of farm produce. 8, is contemplating securing a bank loan for his children's education or an education insurance policy that will equally cater for the children's education required. Suggest a scheme of tax planning that would minimize the tax liability of the family of Mr. and Mrs. Kimeli for the year of income and subsequent years. So we'll begin by looking at the A part. So let's start by explaining related party transactions. What is related party transactions? Related party transactions. So we say these are transactions between, or among parties. These are transactions between or among parties which are associated. These are transactions between or among parties which are associated by reason of common control, ownership, management, or other common interests. Management or other common interests. So that's related party transactions. Then we look at transfer pricing. What is transfer pricing? Transfer pricing. So we say this refers to the pricing of goods or services This refers to the pricing of goods or services. This refers to the pricing of goods or services for transfer from one responsibility center, for transfer from one responsibility center, for transfer from one responsibility center to another, or the transfer from one company to another associated company, the transfer from one company to another associated company, then you say the transfer may be between a company, the transfer may be between a company located in one country. The transfer may be between a company located in one country and another located in a different country, and another located in a different country, and another located in a different country. Then Roman 2, evaluate two benefits that may accrue to an entity that applies transfer pricing in its transactions between related parties. So benefits to an entity. Benefits to an entity involved in transfer pricing. Benefits to an entity involved in transfer pricing. The first benefit, a bullet point, you say current pricing. Current pricing of goods. Current pricing of goods and services. Current pricing of goods and services. Current pricing of goods and services. Then you say an effective transfer pricing mechanism. An effective transfer pricing mechanism. An effective transfer pricing mechanism will assist the organization. An effective transfer pricing mechanism will assist the organization in correctly pricing its products, incorrectly pricing its products, incorrectly pricing its products and services, incorrectly pricing its products and services. This will assist in determining the current value. This will assist in determining the current value. This will assist in determining the current value of all its transactions. The current value of all its transactions. The current value of all its transactions, so that the final product, or services is priced accurately. So that the final product or services is priced accurately. The next benefit. It is useful in performance evaluation. It is useful in performance evaluation. It is useful in performance evaluation. Then you say the economic transactions of an entity, are accounted for thus the current transfer price is determined. Thus the current transfer price is determined. You say this is necessary. This is necessary for accounting. This is necessary for accounting. This is necessary for accounting of transactions. Between the interrelated enterprises. Next benefit, it assists the enterprise to comply. It assists the enterprise to comply with statutory legislation. It assists the enterprise to comply with statutory legislation related to relating to inter-party transactions, which have a direct bearing on the profitability, or costs, of a company, Then we analyze B. So we'll say suggested scheme of tax planning for B. Suggested scheme of tax planning. Suggested scheme of tax planning for Mr. and Mrs. Suggested scheme of tax planning for Mr. and Mrs. Kimeli. Suggested scheme of tax planning for Mr. and Mrs. Kimeli. So our suggestions will start from note 3. So note 3 reads as follows. It says, his wife, Lavena Kimeli, is also employed at a basic salary of 54,000 per month with Tops Limited, where Kimeli holds 20% of the shares. So here is what the rules say. If the family means either the husband separately or the wife controls 12.5% or more. So greater than or equals to 12.5% of the share capital, then it means that the employment income of the wife will be put together with that of the husband for tax purposes. So that would mean higher taxes for the family. Not that the husband will take away the salary, no, it's just to account for tax, to determine how much tax will be payable. It means the salary of the wife cannot be tax separate. It will be taken and combined together with the wife. And what determines that is the shareholding. So maybe what we could suggest to that family is Mr. Kimeli should consider reducing his share capital in Tops Limited to less than 12.5% so that the wife's salary can be taxed separately. You see, if they are taxed separately, the tax amount will be less than if the two amounts are combined. So that would be our first suggestion. So we'll say this: Mr. Kimeli should consider reducing his shareholding. Mr. Kimeli should consider reducing his shareholding. Mr. Kimeli should consider reducing his shareholding in Tops Limited. Mr. Kimeli should consider reducing his shareholding in Tops Limited from 20% to less than 12.5%. To less than 12.5%. This is to avoid combining. This is to avoid combining. This is to avoid combining of the wife's employment income. This is to avoid combining of the wife's employment income. In Tops Limited, together with that of the husband. For tax purposes. Together with that of the husband for tax purposes. Together with that of the husband for tax purposes. Okay, so maybe our second proposal may come from note number 4. This is what note number 4 says. They both live in a house which is owned by the wife. The house was constructed through borrowed funds at an interest rate of 15% per annum. So from the reading, the wife will benefit from mortgage relief, which we talked about earlier, right? But the mortgage relief has a limit. It's very limited. You cannot get more than 25,000 per month. I hope you still remember that. 25,000 per month or 300,000 a year. However, we don't know. We've not been told about the amount of the loan where she's paying interest. Most likely, this interest is much higher. The interest she's paying for 15%. So what can be done? Maybe we should change the status of this property so that instead of the wife claiming mortgage or mortgage relief for owner-occupied, which is much lower, we should change the status of the property to make the rental. The wife should declare that this is rental property so that she stops claiming, say mortgage relief, which is limited, and actually goes ahead and claims the full interest against the income she gets. Of course, the condition, okay, let me just mention this first. If she changes the status to property, then from the income she can deduct expenses. So expenses that will be deducted will include that interest. There are certain other expenses that were going into the house, like insurance. There's another expense she was paying. So all these expenses can be charged, but there's a caution to that. Because from 2014, there's a bit of changes in management of rental property. So management of rental property has two regimes. There's a monthly rental regime. The monthly rental regime is for those whose property can generate income of up to 10 million shillings. So if your income is up to 10 million or less, you're not allowed to deduct expenses. You will just give the commissioner 10% of the rent. So if that is the case of this property and it doesn't reach 10 million, then they'll not get the advantage of deducting those expenses. But if the income was more than 10 million, no, 10 million is, 10 million per month, then you enter in the other regime, which is called standard income tax regime. For standard income tax regime, then you prepare a statement annual, then you deduct all the expenses. But from I don't know what the property is earning. I don't know whether the only property they own is the one they are staying in. So if the only property they're owning is the one they're staying in, then it's unlikely it can earn 10 million per month. Then it will not help even with changing the status. You know, this provision would have helped if the income was more than 10 million, but we'll put a caveat. We'll put a condition that assuming the property can earn up to 10 million, then the option would have been to convert the status to property instead of rental, because for property, there's no maximum. You can charge interest on loan, the exact amount, and you only pay tax on what is left. The only bit that is tricky is that the income must be more than 10 million. That's the tricky bit. But we'll put a caveat. So you say this, Mrs. Kimeli should consider changing the status. Mrs. Kimeli should consider changing the status of her house. Mrs. Kimeli should consider changing the status of her house to rental property. Changing the status of her house to rental property, where she can be able to charge expenses, on the property, the expenses on the property, such as the interest on loan, without a maximum limit. The interest on loan without a maximum limit. Was there any other expense on the property? Yeah, any insurance or anything. Such as the interest on loan, which has no, without a maximum limit. However, we put a caveat, however, under the monthly rental income tax regime, or in brackets M&I, our income from property, our income on property must exceed 10 million shillings. Our income from property must exceed 10 million shillings. Uh, 10 million shillings may not necessarily be monthly, even if they are earning something monthly, but maybe the rent for the whole year is more than 10 million, then it must be more than that for her to be allowed to charge expenses. So if you put a qualification like that, then that statement is still valid. Then that was not for. If she does that, then she can charge the whole interest without limit. Unajua kama ni owner occupied, there's a maximum of 25,000 shillings per month or 300,000 a year. Then there's not 5. The employer paid school fees for the children of Albert Kimeli. Now, what's the condition for school fees? So school fees is usually allowed as a deduction. Is it a deduction? Not necessarily a deduction, but now we are talking about a non-taxable benefit, non-taxable. It will not be included as part of the benefits of the employee, but there's a condition. The only condition is that the employer must pay tax on it. It can either be tax on the employer or the employee. So we might ask the Kimeli to request the employer to pay tax or not to deduct it from their statement of income. You see, if they deduct it from their statement of income, it means they've not paid tax. Then that amount must be added to the salary of Mr. Kimeli and tax. So it's conditional. Let's say this for the next point. It should be point 3. Yeah? So you say Mr. Kimeli should request his employer. Mr. Kimeli should request his employer to treat school fees. Mr. Kimeli should request his employer to treat school fees as a non-allowable expense in the books of the company. To treat school fees as a non-allowable expense in the books of the company. To treat school fees as a non-allowable expense in the books of the company. This will enable the school fees to be treated. This will enable the school fees to be treated as a non-taxable benefit. Will enable the school fees to be treated as a non-taxable benefit on Mr. Kimeli. As a non-taxable benefit on Mr. Kimeli. Then number 6, he was a member of an registered pension scheme where the employer made contributions towards the scheme on his behalf. So you see, if you're making contribution to a scheme that is not registered, you cannot get the deduction. The allowable deduction of 20,000 up to 20,000 a month to reduce the taxable amount. So again, we would suggest to Mr. Kimeli that he talks to the employer to maybe change contributions to a scheme that is registered so that it can benefit him. So next should be number 4? So we say Mr. Kimeli should propose to his employer. Mr. Kimeli should propose to his employer. Mr. Kimeli should propose to his employer to make contributions to a registered pension scheme on his behalf. Mr. Kimeli should propose to his employer to make contributions to a registered pension scheme on his behalf. This will enable him to enjoy allowable deduction. This will enable him to enjoy allowable deduction. This will enable him to enjoy allowable deduction from his income, up to a maximum of 20,000 shillings per month, up to a maximum of 20,000 shillings per month, up to a maximum of 20,000 shillings per month, or in brackets, 240,000 shillings per annum. Up to a maximum of 20,000 shillings per month, or in brackets, 240,000 shillings per annum. Then there is point 7. The wife runs a farming business where she earned 400,000 from the sale of farm produce. Now, how do you treat farm produce? So farm produce may be, so we might maybe advise the family to each submit their own separate returns. So if they submit their separate returns, then this produce will be taxed separately on the wife. Because if they don't submit separate returns, then all these will be combined in one assessment and the tax will be higher. The other aspect, and this I just want to mention, it's not relevant here. About farm produce, it depends on the percentage of consumption. How much do you consume? So for example, if the family can consume up to greater than or equals to 25% of farm produce, then you call that hobby farming. That kind of produce is not taxed. If you consume up to 25%, then you call that hobby farming. I just wanted to mention that, not that it's relevant here, because here we were not given the consumption. So in a different setting, the examiner might give you a consumption to test you, maybe 18%, or tell you 30% of the produce was consumed, then you should be able to make the proper advice, so that if there's consumption involved, then you decide based on 25% whether it's hobby farming or not. But for this one, the relevant suggestion is that they should each file separate returns so that the 400 is taxed separately on the wife, is not combined with that of the husband. So next point to say, Mrs. Kimeli is advised to consider, Mrs. Kimeli is advised to consider filing her separate returns. Mrs. Kimeli is advised to consider filing her separate returns, so that her farming income is not combined. So that her farming income is not combined with that of her husband, so that her farming income is not combined with that of her husband for tax purposes. So that her farming income is not combined with that of the husband for tax purposes. And the last point, 8, he is contemplating securing a bank loan for his children's education or securing an education insurance policy which will equally cater for his children's education. For tax purposes, we'll advise him to secure a policy, because a policy will give him the insurance relief of up to 15% of the premiums paid during the year, or a maximum of 60,000 shillings. So the last proposal, we say Mr. Kimeli should consider. Mr. Kimeli should consider securing an education policy. Mr. Kimeli should consider securing an education policy for his children. Mr. Kimeli should consider securing an education policy for his children instead of a bank loan. Instead of a bank loan, because he'll be entitled to an insurance relief. Because he'll be entitled to an insurance relief. Because he'll be entitled to an insurance relief of 15%. Of 15% of the total premiums paid. Of 15% of the total premiums paid. Of the total 15% of the total premiums paid, or a maximum of 60,000 shillings, or a maximum of 60,000 shillings per annum. or a maximum of 60,000 shillings per annum, or a maximum of 60,000 shillings per annum. So I'll give you an assignment. Please try September 2015. September 2015, I think, is question 3B, I think. It's called violate a woman. This one is computational. You evaluate an advisor on what offer of employment she should take. In on offer of employment. Offer of employment. I think it's September 2015, question 3B. So I think we'll stop there. So that next time we look at this, and then we look at the next area of tax planning, B, corporate tax planning. And then we'll most definitely finish in the next class, so that we now think in terms of block release or revision. What date is your exam?
60.
So you have a lot of time.
1 month.
So you have a lot of time. You'll be having a lot of time. So what is the date ya official ending of classes hapa ni tarehe 20 ama 25? So we'll just be revising. So we'll have this rare opportunity to revise longer. It's very rare these days. I think last semester I only revised for a week. I only had a week to revise. I think for early morning, I think 2 classes only to revise. The early morning class. But that was not for evening. You see, for you, the thing that works to your advantage is this alternate class, which the early morning doesn't have. And then the early morning class is shorter. It begins at 6:15 and ends at 7:50. But hawako mbali sana. Leo tulikuwa tunafanya topic gani? The somewhere. Okay, enjoy your weekend.
Bruno, I think I removed this by mistake. This is yours. This is your paper. Oh,
okay. So me have to for daddy.
Before the class.
How to reduce your sleep? You will tell. You can tell it from my notes. This was not sleep.
This class recorded.
Okay, so we just end it. It was recorded, so we now just